On to my next topic, that why am I trading Forex and why am I doing this Forex mentorship? Because it's a question that I'm getting asked a lot. Why is price action so difficult right now? Why is trading so difficult right now? And essentially that comes down to what you can see here. And this ties in nicely with another question that I got asked is, what is dealing range theory, or DRT? What's it supposed to be used for and how can it help? When you look at this price chart in front of you, especially for somebody who is fairly new, it doesn't make a whole lot of sense. And one of my purposes for this mentorship is to help you identify times where you're going to have easy price action in the form of low resistance liquidity runs, and you're going to have time where price action is more difficult to read. Dealing range theory is like the canvas for the markets. The buy and sell programs are going to run inside of dealing ranges. And the whole market moves from dealing range to dealing range to dealing range. And just like price, the dealing range structure is also fractal. Essentially, the dealing range is the structure of the markets, and it is the canvas for PD arrays and candlesticks to print. DRT levels are true structural support and resistance in the market. It allows us to categorize the markets into premium and discount ranges, and it also allows us to mathematically calculate how high or low a buy or sell program will be permitted to move. Dealing range theory, or DRT, is the glue that holds all of ICT concepts together. When you get to a good enough level with ICT, you will understand that it's the final piece to the jigsaw. Again, this isn't renaming, rebranding anything. This is pure ICT. And it's meant to help remove that fog where you're questioning, what order block do I pick? What fair value gap do I pick? And I absolutely understand that. I was at that stage for many years. When I really understood dealing range theory, that's what unlocked everything. And you're not going to be able to get it in just one video or me speaking about it. It's going to require you to go into your own charts, back test and forward test, and see how price is reacting at these levels, and look for algorithmic signatures in price that are revolving around the DRT levels. There's going to be this blend of confluence of key levels where time and price aligns, and how DRT gives the structure of the market. Anyway, let's get into today's teaching. I hope you can hear the audio correctly. I'm currently not in my office at the minute and I'm away on business. So I've got a new microphone and been playing around with the settings. I just hope it's clear enough for you to hear me. When you look at this chart in front of you, the two reference points that we want to focus on is this high, which ran the buy side liquidity above this swing high, and this low, which ran the equal lows or the sell side liquidity below these relative equal lows down here. Now, if you notice, this high has a lower high to the left, a swing high, and it has a lower swing high to the right, making this a long-term high. Again, this has already been explained in the Advanced Market Maker Model course, but when we're looking at institutional swing points, we can categorize from short-term highs, intermediate-term highs, and long-term highs. The longer the term, the more liquidity is going to be resting at those levels, because this is where institutions are looking at, right? Once we have identified the highest high in our dealing range and the lowest low in our dealing range, we can then grade the entire range into our DRT levels. Again, if you want to look back at episode 1 for reference, since I already explained it all in there, but there's going to be obviously an element of repetition, because this is how we learn and this is how we train our eyes, right? So I did this study on the 2 monthly time frame, if you recall, back in episode 1. The same logic and the same principles I'm going to apply on this daily time frame. So already you can see that we have been consolidating inside of the lower half of the dealing range, right? So we've been consolidating inside of a discount relative to the dealing range high and the dealing range low. That's the first observation point we can see, and I've got a lot of data on this chart, right? This is going back to September 2023. One thing that I notice with a lot of my students is they're too zoomed in, right? You want to zoom out, get as much detail as you can so that you can see the bigger picture, right? You can see the overall parent dealing range. This is how it will give you your reference points. We know that we're in a longer term consolidation inside of a discount relative to the parent dealing range. You can see how we haven't closed here above the equilibrium price point. Note all the consolidation around the lower 25 DRT level. Note this fair value gap over here. It's going to play a pivotal role, and price is going to be consolidating around this fair value gap. And it will have a role in the future. And this brings me on to a question. How do I know when a fair value gap is going to be used again? Well, it depends on, number one, what type of fair value gap there are. There are different classifications of gaps. And again, this has all been explained in the Advanced Market Maker model course. There are going to be certain key fair value gaps that are going to be utilized by the algorithm, in some case many, many months later. Of course, it's relative to time frame. But where these gaps form inside of the dealing range is going to give you a clue. Now, some gaps can be used in the same way as we would use the opening price of a session or a candle, for example. I'll get into a little bit more detail on that at some point, but for now, I'm going to dim these DRT levels just to keep them on the charts, but just to make things a little bit more tidy, right? What other observations can you see here? Well, we've already discussed one of these here, is the equal lows. This is a major sell side liquidity pool. Number one, because it being on the daily time frame. Number two, because this is a double bottom. So what are retail going to look at here? This is support, right? This is a trap for retail. They will create equal lows to build up sell side liquidity below those lows, and then they will go on to attack it. Smart money were selling up here. They were selling over here, they were selling here, and they were selling here. And to cover those shorts, they're going to be buying back the sell stops below these relative equal lows and accumulating long positions down here, right? So they've bought from the sellers, and then they've sold back to the buyers above these highs, these highs, these highs. And if you recall in the first episode, one of the parameters that the algorithm looks to do is reprice back to where? Equilibrium, right? In the lower quadrant, so from the 25% DRT down to the 0 level, what can you see? We have these consecutive down close candles. Look how quickly it's running. It's all being jagged back and forth because this is accumulation of liquidity below the market and above the market. Retail will see this trend line forming, and then they quickly take the market lower. You can see how we've got all of these gaps here. Why are they taking price down there in such a manner? Because they don't want anybody to get out, right? So people who have their stops below these lows, they don't want to drift down there slowly and give them time to get out of their positions. They're going to really run and attack those positions. This run lower, sweeping all this sell side liquidity, all these down close candles are creating what? An order block, right? More specifically, this is a bullish order block. Now, we can grade an order block just as we can grade a fair value gap and just as how we can grade a dealing range. An order block will be made up of one big down close candle on a higher time frame, and every candle is a range in itself. Now, every candle isn't a dealing range. There are specific things required for a dealing range, but every candle can have its own range with its own high, low, open and close. If we grade this whole candle into 4 equal quadrants, we can get the grades of the order block. Notice how in the lower quadrant, where we have this fair value gap, we touch it there and we touch it there. Also note with this candle that we didn't close back below the equal lows to the left. and then we displace higher back through the midpoint of this order block. Also note where we have this gap forming inside of that order block, and then price pushes higher. So this leaves us with these relative equal highs up here in the form of a major buy side liquidity pool. And we also have the sell side liquidity below this swing low as a major sell side liquidity pool. In between the major buy side and major sell side, we have shorter term highs and lows where we're going to have minor buy side and sell side liquidity, right? So above this high, we'd have minor buy side, and below this low, we'd have minor sell side, because the dealing range high to the dealing range low is where we are going to find our major buy side and our major sell side liquidity pools. That is also true for the parent dealing range here. The major buy side liquidity pool above this high is going to house more liquidity than this, and the major sell side liquidity pool below this low is going to house more sell side liquidity than this. When we run the opposite ends of a dealing range, that is crucial as an algorithmic signature. When you're looking for your high probability turtle soups, you're waiting not to take a previous candle. You're waiting to take a previous dealing range, and then the buy or sell programs kick in. I'm going to get into more detail about it all, but what you're going to find is there are many, many, many levels to this, right? I'm going to try my best to keep it as simple as I can and not go off on a tangent, but I do respect your time, and I'm trying my best to pack in as much value as I can here. So anyway, let's keep it moving. Now, what other point of interest would I be interested in inside of this dealing range? Now, if you followed me for a while, you know that there are only two things that the algorithm is going to reprice for, is liquidity or inefficiencies, right? Since we are in a discount relative to the dealing range, I'm looking for the algorithm to reprice above equilibrium into a premium, and I'm looking to see if I can see any liquidity or inefficiencies inside of a premium relative to this dealing range. I can see this sell side imbalance over here, where we've only had price offer one-sided delivery, right? Sell side. So this sell side imbalance sits above these relative equal highs, which sits just below the 50% DRT level or our equilibrium price point. So I know that this is a very logical area for the algorithm to reprice to. Now, does that mean that's going to happen straight away? As traders, we are speculators, right? In a way, we're playing a detective to understand the movement of price and forecast the movement of price. This theory of not being able to time the market, not being able to predict where the market is going to go, that is taught by people who have no idea what they're talking about, right? Our job as speculators is to predict market price. This is how we make money. If you can't predict where the market is going, you're gambling, right? The caveat is you're not going to know 100% for certain that the market is going to play out to your expectations. You have an expectation and you stick to that expectation. That's going to be your bias, and you're going to form that bias by understanding what is the market reaching for. You keep that bias until you are proven otherwise. And there may be something in the market that comes up and trips you and says, well, this was a level that I was looking to hold as support or resistance and it didn't do it. And then you have to sit back and you have to reassess. If you've seen ICT do his live streams, there are many times where he's wanting the market to do something, but it does something opposite, and that gives him feedback and information. And then he says, I am no longer interested now in buy side, and my attention now goes down to sell side, right? It's if and then, and there's certain things in price that is going to trigger you to form that bias and make that decision. So from a longer term perspective here on the daily time frame of the dollar index, this area here looks appealing to me. We also have the minor buy side liquidity pool in the form of these relative equal highs that also sit below equilibrium. So I see there's a lot of liquidity above the market in the form of buy side liquidity, and I can see a big inefficiency here, right? We're going to have a lot of up and down movement before we get to this level, if we get to this level at all. If I have strong conviction that the daily and the weekly is moving higher, then I'm predominantly going to look for buys on the lower time frames if I'm intraday trading. Not every single day is obviously going to be a buy day. If I am counter trend trading to the higher time frame bias, which I often do, then I reduce my risk in half most of the time because it is going against the higher time frame direction. Anyway, let's zoom in here on this piece of price action and I can talk about this in a little bit more detail. So here we are zoomed in. We have the major buy side liquidity pool in the form of these relative equal highs that just sit below the equilibrium price point of the parent dealing range. We have the major sell side liquidity pool below this low, and we have that daily sell side imbalance above the market. I want to now dissect this range. Now we can use the high to the low. We can also grade the swing from the highest rejection block, so the highest up or down close, to the lowest rejection block, so the lowest up or down close. Now I'll get into calibrating grades at some point as well. Now there are different reasons for me grading or calibrating a swing. It's because I'm familiar with which signatures I'm looking for at what particular level, right? Because there's going to be a discrepancy between brokers, you're going to know that obviously there's going to be different highs and lows between brokers. So sometimes if I can't get a clear read and levels aren't aligning, I'll opt to use the bodies because that's where the volume is going to be, right? Sometimes I'm going to use higher time frame levels that are overlapping in close proximity, and I will tend to anchor my fibs from those higher time frame levels. There's no secret science to it. It's just using a bit of logic. In the beginning, it's better to just use the high and low and look for levels in close proximity to those DRT levels. As you get more experience, you can start calibration of these DRT levels and refine things. Now I've calibrated this dealing range and we have the initial consolidation here inside of the calibrated dealing range from the body to the body. Now this candle we displaced lower, closing back below this swing low, after we had ran buy side above this high and this high, and also dipped above the rejection block here. We don't want to do anything until we see this happen, because you're going to get chopped up and down inside of a consolidation, and this is something why ICT says let time do the heavy lifting, right? This is an algorithmic signature that gives us the green light that a sell program is about to commence, and leaving this fair value gap here is an important part of that signature. Again, all of this has been discussed in the Advanced Market Maker Model course. So we've completely filled in this sell side imbalance over here, making this a key high, and then we have our expansion lower from this high all the way down to this low down here. If I take this high down to this low and I project deviations lower, 3 standard deviations over here gives us a level of 100.617. We get 100.588 over here. We would round this level up to 600, and we'd obviously round this level down to 600. And this is how you do calibrations. This level also overlaps with the order block level. It also overlaps with the old equal lows and a fair value gap to the left, which is why it's a logical level. But again, that's just going to come by way of experience. Note how 1 standard deviation here overlaps really, really nicely with the equilibrium price point. Note what we see in the lower quadrant of the dealing range. We have these consecutive down close candles. What does this form? This forms an order block. Note the opening price of the order block. It sits dead on that 25 DRT level. When price runs through the opening price of this order block, this is a change in state of delivery. This means that we have shifted from a sell program into a buy program. And now the algorithm is only interested in offering buy side delivery. Note how we come into it here. Retail ICT, because there's such a thing as retail ICT nowadays with everybody trying to teach what they don't know, they're going to look at these down close candles and they're going to say, well, this is the order block. No, it's not. The order block starts there. This is where we had the sell program that ran the lows, forming the order block. We have these relative equal lows, so there's a lot of sell side liquidity engineered above the order block, and then we tap into that order block here. Notice how we accumulate around the 25% DRT level and go into this consolidation. Note that we had this buy-side imbalance inside of the order block, and we had institutional order flow entry drill over here. At the 50% DRT level, or equilibrium, we have the same thing. We have these consecutive down close candles that run into the old order block, that run the sell side liquidity. We take the opening price and we extend it across. You can see how we find support here at the opening price. It's really nice price action there. More specifically, price is reacting to the high to the open. What is this structure? What is this PD array? It's an order block, but more specifically, this is an order block that has tapped into our parent order block and moved away from it. This becomes a propulsion block. The high to the opening price of the propulsion block, and look at the bodies over here. We wick into where? The equilibrium price point. And then what happens? Price really explodes higher. We come and touch it again one more time over here. That's a signature in itself, because I don't want price to come back into an order block once it's left like this. And if we do, I want to see an explosive move away from that area. And we haven't. We've been quite lethargic. So I'm going to get into this piece of price action over here, but this is already indicating some element of weakness to me. After we came into the propulsion block, we moved higher. Where did we go to? We came into this liquidity void. This is an actual gap, right? It's the absence of any bodies or wicks. What else does this price point overlap with? The midpoint of the initial range that gave us our projections. We can calibrate that to 106.5. You can see how we're failing to leave a body in that gap. We're failing to get above it or close above it. This straight away indicates that there's weakness here and the market might want to roll over. We then see price run lower, close below the 75 DRT level. Leave a small fair value gap. Look at the bodies respecting that DRT level. What is this indicating? That price wants to move lower. What are we seeing occur at the same time as all of this is happening? Well, if we look at intermarket analysis between a correlated pair like the British pound, when we was making this high on Tuesday 16th of April, we were making this low on the pound. On Monday the 22nd of April, we had posted a lower low with pound, but we failed to post a higher high. So this is an indication that there's something going on, right? On the 1st of May, we post a higher high with the dollar index, but on the British pound, we fail to post that lower low since they're inversely correlated. On the 9th of May, the dollar index fails to post the higher high when we see the bodies rejecting to close above the 75 DRT level. On the British pound, we see it post a lower low. And then what happens? And then we see the dollar index displace lower, and we see the British pound displace higher. It's also worth noting that we've completely rebalanced the sell side imbalance created on the dollar index on the 15th of May, and we haven't even dipped into the buy side imbalance posted on the 15th of May. Now notice what I'm saying, right? I'm talking about the dates. Smart money tool, smart money technique. It's not. It's smart money time, right? And in my opinion, I think when ICT talked about SMT and he was very vague about it being called smart money tool or smart money technique, it's actually smart money time, because that's just going to give it away, right? It's time. Time is the most important factor. When are the highs and lows forming? It's not just any high and low. What I just said there is a huge gem. And I'm going to coin that term, smart money time. That's what SMT stands for. Go back through your charts and backtest and pay attention to the time, the session, the day of week, the month. And this is going to give you so many light bulb moments going forward. Anyway, let's get back to the dollar index here. So you can see how we ran above this high here. This high became an intermediate term high because we rebalanced this sell side imbalance over here. We ran above that level here and into the equilibrium price point of a consolidation. After we seen the SMT divergence between the British pound and price failed to get back above the 75 DRT, and we've seen this breakdown with displacement below this swing low over here, leaving this sell side imbalance. Now, what am I looking at here? I'm looking at what retail are thinking. Retail are looking at this trend line here. I'm looking at this as a whole lot of sell side liquidity that also sits inside of a discount relative to our dealing range. I still anticipate that we could likely run higher to sweep the buy side above here, and dip into that sell side imbalance. But I'm anticipating that before they do that, they're going to upset the retail sentiment. Now, there's a few reasons why I'm anticipating higher prices. Is because we do have election year, right? I don't think the dollar should be where the dollar should be. In my opinion, I think the dollar is going to drop longer term. Looking at the way the economy is, it doesn't make sense for the dollar to be propped up, and of course everything's manipulated, and they're going to most likely manipulate a higher dollar going into the general election. Seasonally, we should be running higher on the dollar at the minute, and we're not. We've run lower, but I'll get into that in a second. Let's zoom into this piece of price action, and I can then get into a little bit more detail. So here we are, zoomed in. Now, last week I said that we have this sell side imbalance, and we were being held below the consequent encroachment of this sell side imbalance. On Monday, we failed to close above the discount low of that sell side imbalance. On Tuesday, we failed to close above it, but we created this down close candle. On Wednesday, we dropped into that down close candle, and then we really ran and fully closed this sell side imbalance. Thursday, I was looking to see, do we want to close and have any legs to run higher? We dropped all the way down into the discount low of that sell side imbalance. We found support there, but what is this here? This is an immediate rebalance, right? So the next candle, I'm anticipating for this to run higher. If it does not do that and it breaks down, and I have still an underlyingly bearish bias to run the lows down here, this is going to give me a clue and an indication of what price is likely to do. On Friday, instead of finding support on the premium end of the sell side imbalance, we break down and close below the consequent encroachment. Now, we can mohawk outside of a fair value gap, obviously, which is why we place our stop, the candle that created the fair value gap low in this case. So this candle here, we'll be placing our stop above this high. There are a lot of people who place the stop above the premium high of the fair value gap. But because we can mohawk outside of a fair value gap, you should never place it above the fair value gap. Some people place it above the candle that created the fair value gap, and in my experience, you can still get tripped out, like as you can see over here as well. So a safe stop would be above the high of the candle that created the high of that sell side imbalance, right? And vice versa if we're on a buy side imbalance. What else am I noticing? I'm looking at this inverse fair value gap here. So we have this buy side imbalance. We came down, we fully rebalanced here, and look at the bodies. And then we ran higher, very sluggishly, back up into the premium high of this inverse fair value gap. In order for me to be convinced that we've turned a corner, we'd have to find support at the consequent encroachment of this inverse fair value gap, and then really displace higher. However, above price, we have these consecutive up close candles, making a bearish order block. Inside of that bearish order block, we have this volume imbalance. And you can see how we're touching the consequent encroachment, bodies not getting back above that volume imbalance. And we also have these consecutive down close candles. So we have an area of mitigation to the left. Unless the market tips its hand and really shows me that it's going to displace away from this area. But since we came back into the order block and since we filled in this sell side imbalance, price has been very lethargic, right? This is giving me an indication of weakness, right? And again, dipping into the order block one more time was another reason why I'm thinking that price is running lower. There are a whole lot of other reasons, and this is with intermarket analysis as well, and understanding how dealing ranges work with measuring strength, and that's another topic and study that I'll get into at some point. Between May, April and June, we anticipate seasonally for the dollar index to be bullish, right? May is generally a very, very easy seasonal tendency to see the dollar go higher and to see a decline on pound and euro. However, we aren't seeing the decline here seasonally as we should be doing. So This is again giving me a reason to think that price may want to drop lower and upset the retail sentiment with the retail trend line. There are 3 key levels in particular that I'm looking at. The premium high of this sell side imbalance, the premium high of this inverse fair value gap, and the actual high of our breaker / distribution block. Until I see any convincing movement with displacement above those levels, I'm only interested in shorts. I like how we've also had this smaller intraday retail trend line being created here on the lower time frames. So again, this fits the narrative that we want to see price move lower. Now, we do have a bank holiday on Monday, and we have some high impact news towards the end of the week. And you want to look at that economic calendar as a roadmap and filter out the times that you want to be in front of the markets. And again, that is an absolute great study for you to go and backtest and see how the market responds during high impact news events. Again, that's something that I'm planning on getting into during this mentorship. When we get more into the intraday price action, that's something that I'm going to really bring heavily in. So with that, I hope you guys have found this one insightful. There's again a lot of information that I've thrown at you today. You may have to go through it a few times, but if you have found any value out of this, please leave me a comment below and subscribe and like this video. It'll help the channel. Again, thank you guys for watching, and I will catch you again in next week's lecture. Take care, guys.